Thank you for joining, everybody. I know it is now 2:01. We are letting folks filter in, but I want to make sure we give as much time to our presenters today as possible. So thank you all for joining us at the Connecticut Affordable Housing Conference. My name is Danielle Hubley. I manage advocacy and education here with the partnership. This year, the conference theme is Here for Housing. It is our opportunity every year to come together, convene, collaborate, and drive meaningful change to improve and expand housing affordability, creation, choice, and stability across our state. This year, the conference, as you are all well aware, is virtual. So if you're planning to engage on any social media account, please use the hashtag CAHC2024 and join the conversation that way. We love seeing what everybody's taking away from conversations, what kinds of things you're picking up, what things you plan to bring back to your work. So please join us that way. This session is entitled Low-Income Housing Tax Credits, a discussion on key matters. And we're here from 2 to 2:50 today. So just so you know where you are to orient yourself to the conversation we're having. Really quickly and always and forever, I will be thanking our conference sponsors, our presenting sponsor, Connecticut Housing Finance Authority, our visionary sponsor, Wells Fargo, our champion sponsors, as you can see here. Similarly, for our foundation sponsors, this conference is not possible without all of their support. So it's our privilege to recognize and honor them in each of the sessions. Making this learning free and accessible to as many people as possible is so important to us. And we, like I said, could not do that without their support. Today's session is being sponsored by Whittlesey, who is the majority of the crew here with us today. So thank you so much for sponsoring the session and for being a part of the conversation this year. Really quick housekeeping items. The session is being recorded. We make all recordings available to our YouTube channel. It should be available online sometime the first week of December is our goal. So keep an eye out for that if you'd like to tune in or catch something that you may have missed. You've all come in muted. Please plan to stay muted. It allows our presenters to be able to clearly communicate the information to you. If they will plan to have you use the chat function to ask any questions. So plan to drop in comments, thoughts, reactions, questions that you have for our presenters today in the chat. You'll find that at the bottom right-hand side of your screen. If you are having any tech issues, you can reach myself, Danielle, in the chat. You can message me directly and we'll do our best to troubleshoot and make sure that you have access to the content you're here to learn. My last request really is that at the end of this session in the lobby, there is a little megaphone icon you can see on the screen here. Once the session ends, you will get a notification to complete a session survey. Please take a few minutes. It should not take you very long to fill that out, but your feedback is always so valuable and important and helps shape next year's conference. So please give us that feedback. We super appreciate it. And I think those are my biggest talking points. Thank you so much for being here today. We're so excited to dive into this conversation and learn a little bit more about the tax credits. So without any further ado, I'm going to pass it off to Nico to take it from there.
All right, Danielle, thank you for that, taking care of a lot of those housekeeping duties. I can imagine putting up a program together like this. It's a couple days with lots of presentations is a lot of work. So our thanks to you as well as everyone at the Partnership for Strong Communities for putting this together, and obviously the sponsors that kind of make all of this happen to get this going. So we appreciate what you guys do to put this together. So what we're going to do today is have a kind of a round table, although it's not round, as you can see, discussion with regards to tax credits and low-income housing tax credits and how they work in Connecticut. We can appreciate there's a wide view of people that have different levels of experience. So we'll try to keep it appropriate for everyone. Certainly, if you have questions, feel free to ask those in the chat and we'll try to answer them. So joining us today is Melissa Braun and Ed Engberg from Whittlesey and Greg Burton from Carmody Torrance. Greg's an attorney while the rest of us are accountants. And so what I was going to do is, Ed, I'm going to pass it over to you to give a quick intro of yourself and kind of what you do in the affordable housing arena.
All right, well, thank you, Nico. So my name again is Ed Engberg. I've been in public accounting now for It's come close to 19 years. And I'm currently the head of our real estate niche here at Whittlesey. And, I think one of the key things that I find that's interesting about my work in low-income housing tax credits is I also grew up in a low-income housing tax credit, project. And so, I've seen, the benefits that brought to my family. And now I'm seeing the benefits that it brings to many families across the state. Go to Melissa.
Greg, you want to give us a quick
Greg.
intro?
Sure. Greg Burton, I'm a partner at Carmody, Torrance, Sandak, and Hennessy. I sit in our New Haven office. We have offices in Stamford, Guilford, New Haven, and Waterbury. I've been practicing in the affordable housing area now for over 20 years. A little hard to imagine that that's true, but I checked the math and it's right. And so it's about 95% of what I do these days, and worked with a number of clients across the state, for-profit, nonprofit organizations, as well as a lot of out-of-state developers when they're putting together development in Connecticut. So happy to be with you all today.
All right, thanks, Greg. And I'll add, so I've been doing this since about 2008, and I was really excited. I got to the point last year where a project that I worked on at the very beginning, when it started occupancy back in 2007, I believe, finally hit year 15, and we got out at 2023. So I was like, I got to see this kind of from the beginning, at least through year 15, and we'll talk a little bit more about that later. The third person we have here is Melissa Braun from Whittlesey. Melissa, you want to give us a quick intro?
Sure. So as Nico said, I'm Melissa Braun. I'm one of the tax partners here at Whittlesey. One of my largest practices is in affordable housing, and I've been doing this for a little bit over 12 years now. So it's a fun space to be in, to see the deals get started and walk us through, operations and seeing how these are built and how cool they come out at the end. So
all right, thanks, Melissa. All right, so we're going to do a quick, just high level, and Melissa's going to just talk to us a little bit about the two different types of low-income housing tax credit deals. So again, this just kind of ground everybody kind of what this world is like, because I know we've got people with different experience. So Melissa, you want to talk a little bit about the two different types of low-income housing tax credit deals?
of course. So the two primary credits or kind of deals that you can do is you do a 4% credit or a 9% credit. So generally, when you're looking towards the 4% credit, it's a lot of acquisition, rehab kind of deals. You subsidize about 30% of the low income units over 10 years. And generally, it's a lot of tax exempt and private activity bonds. They're a little bit less competitive when you're in this realm. And then kind of switching to the 9%. This is typically a lot of new construction or substantial rehab. There it's a little bit more competitive because you can subsidize, about 70% of the low income housing costs over the 10 years. That's kind of the quick hit between the two different deals.
Yeah, I'll just add, I mean, recently, historically, certainly 4% tax credit has been more geared towards acquisition and rehab, although we've actually seen some 4% deals in new construction where people are able to make the numbers work. It's challenging, and you need a lot of debt financing to make it work. But just as the demand for housing has grown and the shortage of capital necessary to do that construction, we've seen some creative approaches using 4% even for new construction.
Right. Okay. So I think the next we want to kind of start to walk through the process of how does a project like this get, from an idea to actual brick and mortar constructed with tenants in the building. And really, as you saw, the primary sponsor is CHFA, the Connecticut Housing Finance Authority, and they're integral to making these deals happen because they're the ones that basically get involved with the approvals, et cetera. So part of that is the first step in that, beyond the ideas, which is kind of even before that, is putting together an application to CHFA with regards to obtaining tax credits. So Ed, can you give us a quick kind of overview of the application process and what people should be thinking about and how that gets going?
Yeah, definitely. I think first off, I think we could have an entire webinar on just applications. There's some other topics within this that we could certainly go in greater depth. I think what we're really trying to accomplish is to give some key some key sticking points that really should be focused on when you're thinking through, hey, how am I going to tackle this, right? I think when it comes to the application phase, and you're going to hear this across numerous of the parts we're going to cover, we're going to talk about the use of teams, right? And the use of teams, I'm not talking about Microsoft Teams, I'm talking about teams as in using different individuals with different expertise to bring them together to, have that combination of expertise to put together the best deal possible, right? And I think it's a collaboration of the knowledge is what, in most of these situations, will put together the best deal. And so again, so it's using a team to submit the application. I think the application could either be done by a LIHTC consultant, so someone with a lot of experience. This is what they do for a living, right? They are always in front of individuals like Chaff or other types of syndicators. They know this inside and out. Outside of LIHTC consultants, I would say using staff with a lot of experience, right? Staff who have maybe assisted on other deals or for quite a while, or they've just been doing this a while and they know the ins and outs. So in addition to that team, I think it's the team that you're putting together on the application, right? And making sure that that team, such as the property manager, individuals like that have extensive experience. And I think one of the key things you're looking for is at least 3 years or 3 deals. So starting the process, I think you definitely want to read through the qualified allocation plan for the state you're applying in. Make sure you understand that. I think additionally, overall, what you're trying to do in that application is to demonstrate the financial viability of the project. And additionally, I think lastly, a lot of individuals when they're putting a deal together are wondering, hey, how do I pay for this? So I'm incurring a lot of costs, especially if I use all these experts and consultants. This is certainly a cost that would fall under owner's costs and would be eventually be able to be repaid with development fees.
One thing just to add on that too, Ed, is that while the 3 years, 3 deals experience threshold works for the application for tax credits, you got to keep in mind too that you've got to satisfy requirements of lenders and investors. And a lot of times those lender and investor requirements are going to be more financial wherewithal based. So I've had situations before where folks have applied for credits and they've got an experienced team, but if you don't have somebody who can meet those financial wherewithal requirements, so this is in particular for nonprofit organizations, just be thinking about that ahead of time, that just getting over that application threshold might not actually get you to all of the capital that you need in order to put the deal together.
Okay. All right. Thank you, Greg. Once we talk about the application and putting that together, Greg, you want to talk a little bit with us or about the team and who should be on the team and when you get them involved?
Sure, that's all those professional expenses that Ed was alluding to as you're putting together the application. So I'll start with the attorney role, just because that's one I know pretty well. The role of the attorney is actually pretty limited at the front end on the application phase. And it's usually there's usually just a few legal questions that may come up about, formation of entities or, some organizational structure things. Typically, the application phase is mostly going to be geared towards low-income housing tax credit consultant or accountant teams. But it is important to have good legal counsel involved in the transaction. And frankly, a big part of that is really just being familiar with the agencies and the regulations and the rules that go along with this. These transactions bring together a lot of different parties and a lot of different moving pieces, and that's different than a typical financial or real estate transaction where somebody might be buying a piece of property and getting a loan to purchase that piece of property. That's a pretty straightforward structure. But in these deals, we could have 3, 4, 5, I've had 8, 9 funding sources sometimes in these. And so being able to bring all of those things together is key. And a big part of that is knowing the agencies and knowing the players and understanding, their processes, what they need. Every agency is a little bit different in terms of what they're looking for. And so that's what the sort of, kind of critical component there is. keep in mind too, when you're looking at legal counsel, if there's anything peculiar with the development, if there's any environmental issues, if you're going to need to do some kind of condominium structuring in order to structure the development, or energy projects is another big one where we've seen some geothermal projects, photovoltaics, even fuel cell development. And so if you're going to have one of those components as part of your development, it can be a very innovative approach. Just you need to make sure that you've got a team that has the experience with those different facilities to be able to guide you on that. I would say the accountant that you choose, and not just to feather the nest of these folks, these fine folks who are with me here from Whittlesey, but having a really good attorney that is familiar with, having a really good accountant that's very familiar with LIHTC is critical. A lot of times people will ask me questions and they might be a little frustrated because a lot of times what I say is, well, check with the accountant, but I think this and that, right? So I know enough to sort of raise the issue and to kind of frame it and pass it to these folks who can really tell you how. They're the ones that are going to be doing the tax filings. They're the ones that are going to be doing all of the tax credit reports. And low-income housing tax credits, more than anything, are tax-driven. And so that's why you need the accountants involved very early on. You do not want to have a situation where they're coming in after everything's been structured and they go, well, wait a second, you have this ownership entity has this percentage, and now you have a problem because you now can't take advantage of these tax these tax advantages that are necessary for the investor. So very important to have very good and familiar accountants. You may have an accountant that you've worked with for a very long time that you're very comfortable with, but if they don't have experience with low-income housing tax credits, you're going to be poorly situated going forward. And what I found is that most folks are happy to collaborate. So if you have an accountant that you're very familiar with, that you've worked with before, and that you're comfortable with them doing your books, that's fine. It's all well and good. Have them work with a group like Whittlesey so that they can bring in that tax credit expertise that your kind of regular accountant that you've got a good long working relationship with, may not have. Third thing is LIHTC consultant. And again, LIHTC consultant, the need for a LIHTC consultant depends largely on your own organization. Some organizations have expertise in-house to put together tax credit underwriting and pro formas and projections. Some don't. And so those are kind of the two ends of the spectrum. If you don't have any experience with it, then having a LIHTC consultant is probably critical to being able to put these things together, because a lot of the language of the applications and things like that is going to be Greek if you haven't been through this before. But then there's a lot of room in the middle. So I know a lot of the affordable housing consultants and LIHTC consultants can play varying roles. Some of them are kind of start to finish. They'll even work with you through the construction process and handling construction draws and things like that. There's other accountants, other LIHTC consultants that will just do that piece of LIHTC expertise that you may be missing within your own organization. So that's really your team. Like I said, the accountant and the LIHTC consultant very much on the front end. Attorney usually not as involved on the front end, but just make sure that you're planning for further down the road so that you have the right resources in place.
All right. Thanks, Greg. What we're going to talk about next is what we'll call eligible basis. And I'm an old school guy, and we have books that are probably about that thick that talk about eligible basis, and I regularly flip those. They're one of those books that are tattered and have markings all over the place as different issues. But the IRS is very specific with their rules as to what is eligible basis and not, and what eligible basis is. The more eligible basis, the more money investors are willing to put into a deal, because the more basis, the more credit. So really, to the extent you can either hit the target of eligible basis that you need, or that you can grow that, will help you get additional financing. So we want to spend a little bit of time talking about eligible basis. Melissa, you want to kind of kick off with kind of what is eligible basis and take us through that part of the conversation? Certainly.
So as Nico said, you want to maximize the amount of eligible basis so you can kind of maximize the credits that you're able to have awarded to you. So some of the things that kind of are applicable are construction costs or rehab costs, common area expenses, amenities, some of the development, legal consulting. It gets a little tricky there. But if you come with the mindset of, here's the building, if I pick up the building with the foundation and everything, that's a good indicator of at least the first step to kind of talk through eligible basis with your consultants, and kind of a first pass idea.
Okay. All right. Ed, you want to talk to us a little bit about cost savings and what that means in this area?
Just before we move off that, just one thing I want to mention, I think we'll talk about it a little bit later, but the big, the big thing to be aware of is just that land value is not part of eligible basis. So like Melissa was saying, imagine pick up the, building with a foundation. And the reason she's saying the foundation, because what you build in the ground counts, but the ground itself does not. And it can get a little gray around things like site work, environmental remediation, when you're talking about remediating environmental conditions in soil. And so those are that's the big category of things that are not basis eligible. So just to make sure and put that on your radar. I just had a conversation with somebody yesterday because they were pointing out that especially here in Connecticut, the cost to purchase land is extremely high. And so they were saying, well, how do I finance that? Because it's not includable in basis, and that's a problem. That's a challenge. And it's something that is a problem that's unique to Connecticut, just because our, land is a developable land in particular, is a scarce resource in Connecticut, given our geography and so forth. Sorry, Ed, I didn't mean to jump in on you there.
Thanks, Greg. Ed, you want to talk a little bit about cost savings?
Yeah, no problem, Greg. I mean, those are some good comments, and so I'm going to talk about an area that people are probably like, cost savings. How does that work? Cost savings exists, and sometimes it does. And I think really thinking about what does that mean? And so really the key area where cost savings can occur is typically under a construction contingency. So that's an estimated line item. You don't know what you're going to incur in a project, and it is possible where those costs can come under. It's possible where those costs can come in over. And so, I think the key reason why you want to think about that is that let's say if you do have cost savings, you might have sources that, depending on the timing of when those sources are being drawn on, especially if it's going to be drawn on last, then the cost savings could impact your ability to fully draw down on that source. So, what we've always told clients is that typically when a deal is being put together, not all cost and everything that was envisioned that you want to do for the project is always able to be included. And so there could be items that you wanted to originally do, and maybe if you had cost savings, you could then factor doing and incorporating those construction items into your project. And so, I think it's just being mindful of that in the event you are in a cost saving situation where you have a funding source that will be reduced by that, to see if you have other items that you could now cover.
Keeping in mind too that, if you've got eligible basis expenses and you have cost savings on those expenses, if you didn't spend that money, you don't get the basis for that. So you've got to be careful too, if you end up with cost savings in an eligible basis item, to make sure that however you're going to deploy those cost savings, that you're not moving that into an ineligible basis item and causing a reduction in your tax credits.
Correct. Yeah, you're certainly going to, so if it was if you were getting eligible basis previously, which you more likely than not would get it for construction contingency, then you want to keep going in that same trajectory. Yeah.
And one of the things there, developer fee is a basis eligible item. That's one of the big ticket items. And oftentimes when we have cost savings, a lot of times we'll move that to the payment of developer fee, which is still a basis eligible item.
All right, Greg, you want to talk a little bit about, a project having too much debt or why you limit that? And from there, maybe a little bit about the land and building allocation of costs. We do have one question in the chat, and we'll get to that once we kind of finish this topic.
Okay, yeah, I can take that question too, but let me talk about that the debt piece of it first. So we were talking before about, you've got tax credits. It's one source that's coming from your equity. You've also got some debt, right? Because you're not going to be able to finance the entire development with tax credits alone. So you're going to have debt as well. That debt is also serving a dual purpose, because the expenses that you're paying with that debt are going to create basis for your tax credits. So there's a symbiotic relationship between having debt and generating tax credits. The other thing that happens with a loan is that you pay interest, and interest is deductible. So that's going to be a loss. So when an investor comes into a deal, the investor's buying two things for their capital contribution to your project. They're buying the tax credits, but they're also buying the depreciation and tax losses that the project will throw off over time. So having interest on loans. So for example, a lot of times we'll have funds from the Department of Housing, maybe for several $1 million of debt. That may just have accruing interest that accrues over the life of the project. That actually helps to create losses for the investor and creates an incentive for the investor to provide a higher price for the tax credits. So it generates revenue for you on that side. But there are diminishing returns. So if you have too much accrual of debt, then you can actually create some diminishing returns problems and actually start to undermine the impact on the tax credit equity. So without getting into the weeds on it, essentially the investor's putting in a whole lot of money that sets their capital account at the amount that they've invested. Over time, those tax losses and tax credits are going to draw down their capital account. But when their capital account gets down to zero and it turns negative, things get really complicated under the tax code. And so it's good to create losses, and it's good to create additional interest and to have debt that is accruing interest, because that's all going to build additional tax credit equity. But when you get to the point where that debt where those losses start to bring the capital account to zero, that's where you'll end up with a lot of investor tax counsel issues. There's also a couple of other tests that have to be met. There's a true debt test. So the property has to be able to, at least on a pro forma basis, it has to appear that it can pay off its debt over 30 years, assuming that the property appreciates in value and it can be sold to pay the debt. But if you have too much debt on the property where it gets out of alignment with the property value, even making those assumptions over time, then it doesn't constitute true debt. And the IRS is going to look at that and say, that's not real debt because the property can't pay it off, or there's no realistic prospect of the property paying it off. And the worst thing in the world is to have anything related to a tax credit deal get recharacterized. So if the IRS on an audit looks at something and says, no, you said that it was A, but under the tax laws, it's actually going to be B, that's a bad situation in every instance. And the implications of that can be significant, very significant financial implications to that situation. It's also depends on who your debt is coming from. So keep in mind too, related party debt can be an issue that we run into, especially with a lot of the agencies preferring a pass-through structure where we have, for example, DECD funds that are getting passed through a city to a nonprofit and then loaned into the project. Those become related party debt, and related party debt also has some complications. This is, again, just another plug for, this is why it makes a whole lot of sense to have your accountants looking at your financial structure at the outset, looking at your projections and identifying these issues early on rather than having them crop up on you late in the process.
Okay. Do you want to talk about the land building allocation piece of that quickly, Greg? Sure.
Yeah, I alluded to this a little bit before with Melissa, is that, since land is not included in basis, one of the things that I've seen folks get tripped up on a number of times is acquisition price. So, we're going to go buy a building for $5 million. That doesn't mean that we have $5 million of tax credit basis, because we're buying land and a building. And so in order for that $5 million purchase price to get properly treated under tax and accounting rules, it's got to be allocated. Some part of it has to be land and some part of it has to be building. And so we have to come up with a reasonable basis for that allocation. So I've seen people make this mistake before of just assuming that the entire 5%, $5 million or $10 million, or in one case, $60 million, that's all includable in basis. And when you're talking about big numbers, on an acquisition, that can have a real impact. If you have to allocate a lot of that to land value, and again, because of the unique nature of Connecticut, our land values actually are, meaningful. The land value is not trivial in Connecticut, and so making that allocation and then dealing with the consequences of that is really important. So you have to come up with some way of allocating the price. Sometimes, certainly an appraisal is one way of doing it, and we have those cases. But we can also come up with sometimes with creative approaches when we need to justify an allocation that might not necessarily be how an appraiser would look at it, but we can come up with a reasonable basis for making an allocation that's a little bit different. Sometimes using tax assessment values, sometimes using comparable sale transactions.
Thanks, Greg.
Nico, you want me to
wanna-
jump in on that? You want me to jump
Sure,
in on
go
that
ahead.
question? So there was a question here about what happens to tenant rents when tax credits expire. So first off, let me just give you the regulatory compliance period for low-income housing tax credits is it's a 10-year. There are 10 years where the project will generate tax credits. 10 years that it generates tax credits, but there is a compliance period that is 15 years. So that's the initial compliance period, 15 years. And you'll hear lots of people talk about year 15. It's kind of a critical time frame. But the affordability restrictions are also, they then continue for another 15 years beyond that. That's called the extended use period. So it's a minimum total of 30 years for the affordability period when you have a tax credit transaction. Now, that period, the extended use period, that 15-year extended use period can actually be longer than 15 years, and quite frequently it is in order to score points on a tax credit application or because of requirements related to your financing. You might agree to a longer extended use period. And so it's typical for us to see 40, sometimes even 50 or 60 years as an affordability period. So first thing to know is that the affordability period runs a lot longer than the period of time that tax credits are generated from the project. But at the end of that, if you run out that extended use period all the way to the end of it, and again, keep in mind that usually these projects need some substantial rehab during their lifespan. So usually sometime between year 15 and year 25, there typically has to be a rehabilitation of the property. And that rehabilitation is usually going to involve tax credits or some other affordable housing financing that's going to require those periods to be extended out. So the practical reality is that these affordability restrictions typically continue more or less in perpetuity because of each subsequent rehab of the property. But in the event that for whatever reason they actually did expire, there are tenant protections built into Section 42 of the tax code that allow residents, there's sort of a transition period for tenants after an affordability restriction expires.
Right. Thank you, Greg. Moving, so the next kind of the topic we want to talk about is just maximizing the equity that you can receive from investors. And there are a couple different ways to do that. Greg, I think you're going to talk about qualified census tract and difficult to develop areas. You want to give some quick...
So there's so normally, when we've got a tax credit project, you're generating tax credits based on the eligible basis, and then the number of units that you have that you're restricting. So another just relevant term here is applicable fraction. So that means how many of the units are affordable in your development. If 100% of your units are low-income housing tax credit affordable units, then your applicable fraction is 100%. If half of your units are restricted to affordable, then you have a 50% applicable fraction. So we take our eligible basis, we multiply that by our applicable fraction, and that gives us what we can actually generate tax credits on, right? So if it's 100%, you get all of your eligible basis. If it's 50%, you're getting 50% of that effectively. There is one way that you can boost that. So, the applicable fraction brings it down from 100%, but you can actually boost it to 130% if your project is in either what's called a difficult to develop area or a qualified census tract. In rough terms, a difficult development area is an area where the cost to develop is high as compared to the rents. A qualified census tract is an area that statistically has a higher rate of low-income demographics and a higher rate of poverty. And those two designations, DDAs and QCTs, as they are called in the acronym soup of affordable housing, those are reset every year. And they're statistical based on census and statistical data. There is a change. A property may be in a QCT one year, and then it may fall out of the QCT in a subsequent year. There's not a lot of changeover. The changeover is usually between 10 and 15%. So 85% of properties, thereabouts, 85 to 90% of properties stay within one of these areas over time. But there are some that drop in and out. Just be aware that if there is a change while you're in process, you need to jump on that and assess that situation quickly. There are ways to preserve a QCT or a DDA designation as long as you're at the right point in the process and you take the right steps in order to preserve that. But what that does, if you're in one of those areas, is that you actually get to boost your basis up to 130%. So that's a real meaningful difference in the amount of tax credits that you can generate on the project.
All right, thank you, Greg. One of the pieces that goes along with low-income housing tax credits are historic credits. So, and historic credits are done at both the federal and state level, and it's not unusual to see projects that encompass both types of credits. So, Melissa, you want to give us a quick overview of historic credits?
Sure. So generally these are for certified, it's to preserve historic buildings. So you have to be a certified historic structure, or on the National Register or on the state historic district. And you have to do substantial rehabilitation or qualified rehabilitation to kind of get this credit. But in a nutshell, it's an equivalent of 20% of your rehab costs that you do for these historic structures over a period of 5 years. So you can also, as Nico said, there's a federal portion, there's a state portion, it just helps maximize your equity a little bit more in your LIHTC project.
Yeah, and just one thing to keep in mind on that is that there are the low-income housing tax credits and the historic tax credits do not necessarily play well together. So there's a lot of complications that will percolate when you bring these two projects, these two types of tax credits together. Just by way of example, they follow different things. So low-income housing tax credits go with the losses, right? And that's the investors that are investing in all the losses, the tax losses of the project. But historic tax credits follow the cash for the project. So they move in different ways and they have different requirements, and they can actually impact, historic tax credits will actually impact your basis for housing tax credits. And what that can often necessitate, or sort of the path that you can get led down on that, is into some very complicated financing structures where we have sort of like a master lease structure where we have one whole transaction that gets put together for the low-income housing tax credit part of the project. And then we take that building and we lease that to a historic tax credit investment structure. And these things are doable, right? But additional complexity means additional time, means additional costs. These things are all compounding. So if you have one funding source, that's pretty straightforward. You have 2 or 3 or 4. The more you add, it's not 2 or 3, 4 times as much work. It's 5, 7, 10 times as much work, right? Because it's actually exponential when you add in these additional funding sources.
All right, thank you, Greg. Ed, so our last topic we'll talk about in terms of equity is that first year, which is certainly a challenging and at times moving target, where you think the first year when you start is X and it turns into Y because of construction delays or whatever else. So Ed, talk to us a little bit about the first year of credits.
I think the key thing with first year credits is really, managing in a perfect world. If you can perfectly manage the timeline on a project, right? If everything goes according to plan, you get every permit, as you planned, and every inspection done as you planned. And I'm seeing some of the names of some of the individuals who are watching, and I know they're like, Ed, you're a dreamer. But if you are able to, then what you're trying to do is reduce that timeline. And by reducing that timeline, you're more likely to get your buildings completed in a more timely manner, and then be able to get your first year lease up done in line with what you have projected. One of the things to think about is that any of the credits that you're unable to get in the first year do get pushed out 10 years. And so that's why you're paying, we'll call it's an adjuster, we'll call it or a penalty, for the late delivery of those credits. And that's why sometimes people are like, oh, well, it's just pushing out a year. Well, it's not, because you've already factored in the credits, the time value of the credits coming in next year. So now it's getting put on the back end at year 11. And so that's why that adjuster can be so significant. That's really the key thing. I think, outside of that, one of the things you have to focus on is that all of the costs for that bin need to be completed by the end of that year. Any costs that are not factored in that are eligible basis are going to be cut off and not be factored into eligible basis. So you certainly have to kind of weigh the two. if you have significant costs that are yet to be incurred, you want to weigh that against what your timing adjuster is on maybe pushing the credits from that year and deferring to the upcoming year. So big picture, it's all about your timeline and managing that timeline as closely as best as you can.
And that cost can be, on just using some recent examples, if the investor's purchase price per tax credit is 85 cents per dollar, the timing adjuster, if you have tax credits that don't get delivered in year 1 and they get pushed to year 11, you could be looking at a 40-cent adjuster for that, which means that for that dollar of tax credit, you were counting on getting 85 cents, right? But you end up having to pay back the investor 40 cents of that. That's nearly half of the equity that you thought you were generating for that tax credit.
Yeah, so definitely having a timeline and following that and trying to stick to it is very important. All right, the last topic we have is just to talk about kind of partnership and operating agreements and how to do that. We've got about 10 minutes left, so we'll try to be pretty quick in terms of just giving some high-level things to think about. Greg, I'm going to kick it off to you to talk a little bit about, kind of definitions and some of the things you should be looking for as you're entering into partnership agreements. And like Greg said earlier, it's important to involve accountants. It's also very important to involve the attorneys here because they're the ones that can understand the legal wording that are used in these documents.
Yeah, it was nice of you not to say the people who enjoy reading the 120-page partnership agreement, because we definitely don't, but we do it anyway. Before I jump into that, there was just another question here about for conversions, and I understand that to mean when you're converting a property from market rate to affordable, is there anything baked into that process to make sure that tenants are aware of the changes? I will say it's mostly driven by the financing sources. So it depends on the financing source, but almost all of the affordable housing financing sources, and presumably if you're buying a property that's a market rate or acquiring a market rate property and then converting that to affordable, you're doing that because there's some financial resources that are being contributed by a state agency, right? It's very unlikely that you're going to be converting a market rate building to affordable without some kind of subsidized financing. And almost all of those programs have fairly robust tenant participation requirements. So the agencies will want to know that you've had resident meetings and that you've talked with people about the intended redevelopment or rehabilitation or conversion of the building, and that the residents have had an opportunity to have input into that process. So the agencies do a very good job of kind of making sure and holding developers accountable for involving tenants and making sure that tenants have notice and everybody understands what's coming down the pipeline. It does fall to the developer, though, to do that, but it's the developer holding, being held accountable by the agencies. When we then have to report to the agencies as we're trying to close financing, they will have right on their checklist is like, let me see your tenant participation. Let me see, when did you have your meetings? They will require that we demonstrate that we have involved the community in that process. But switching over, Nico, to the partnership agreement. So tax credit partnership agreements, the operating agreement for the company gets entirely rewritten when you bring a tax credit investor into the deal. What might have been a 5 or 10-page operating agreement, pretty straightforward, is going to become a 120-page operating agreement with probably exhibits A through N attached to it. In addition to that. So very complicated agreements. And one of the things that I always tell people is the devil is in the definitions. You can read a provision in the operating agreement and it says that you need to make sure that the property is meeting a 1.15 to 1 debt service coverage ratio. And you might read that and say, yeah, that's what we agreed to. That's what's in the LOI, 1.15. That's what we're doing. Well, now go look at the definition of debt service coverage ratio. And there you're going to find out that instead of using your actual expenses to figure out your net operating income, right? So normally we'd think, okay, I get X amount of dollars in revenue for the building. I paid out Y in expenses. So my net income is the difference between those two numbers. You'd be wrong. Because what the partnership agreement is going to say is that instead of using your actual expenses, you're going to have to use the higher of your actual expenses or the projected expenses. Why? Why would I use the projected expenses? I didn't spend that. I actually saved money. Well, because the investor's smart and they don't want you shortchanging the maintenance of the property in order to meet those tests, right? So they don't want you, well, look, you budgeted $50,000 for landscaping, but you just didn't cut the grass, okay, well, that doesn't work for them. And so that the way that they protect against that is by saying, look, we underwrote, we projected a certain amount of expenses. So the building has to be able to pay those expenses, whether you actually pay those or not. So you have to be very careful about how these things get defined. You can read through the provisions of the partnership agreement, especially when you're slogging through 100 pages, right? And a provision can make perfect sense, but if you're not going back and looking at those defined terms and seeing how those defined terms are spelled out and what the conditions and so forth are for satisfying those, you can completely misread the situation. So always pay close attention to the details, and there's no shortage of definitions either. The definition section will be a good 8-10 pages, so you've got plenty of reading just in the definitions.
All right, thanks, Greg. Ed, do you want to talk a little bit about the waterfall, the cash waterfall and distributions, which again is another key component of these types of agreements?
Yeah, so I think the first thing about waterfalls is that if you are projecting a waterfall.
Hey, Ed, we're having a hard time hearing you. I don't know if something happened on your.
Yeah.
Can you hear me now?
Yes,
Yep, there
much
you go.
better.
Okay. All right. Maybe somehow the mic was getting blocked. I think the first thing is that you want to, if you're seeing in your projections that you're going to have a waterfall, which hopefully you are, I think the key thing is to make sure you understand, how that is going to, how each line of that waterfall is going to get applied, who it goes to, and understand how that works. Some of the key things regarding that is, it can be used for repayment of the deferred developer fee. That's one of the, key items. There's also syndicator fees. They might go under various titles, administrative fees, asset management fees. In addition, I think there's probably some CHAFA members on here, so I should mention this. Additional interest is certainly one of the main provisions. If you did have a below market interest rate, CHAFA will get the additional interest, first as the top priority in the waterfall. Lastly, there is a line item on the waterfall for distributions to the GP or LP. And so, I think it's just key to make sure you understand that and also understand how the regulators are reviewing and approving on what your waterfall, what your surplus cash should be. And if you need an approval before you distribute, to make sure that you have that approval.
Right. Thanks,
Yeah,
Ed.
and that can also, I've seen this crop up, and we sort of expect that, we're going to go through this cash flow waterfall, and at the bottom, most of the cash is going to go to the general partner or the managing member. That's the developer. And then at the very bottom, we'll see 99.99% to the investor. And that's because for tax purposes, we do have to, at the very bottom of the waterfall, we always have to have 99.99% going to the investor. That's to make sure that the tax credits also go to the investor. But that key level in there is, and it can be called different things, incentive management fee or managing member fee, is a 90%. Typically it's a 90%, sometimes 80, but typically 90% cash flow allocation to the managing member. And that's key. That's because we want to push the cash flow to the managing member, even though we have this investor that owns 99.99% of the partnership. But there could be reasons why we can't do that. They're related. If we're buying the property from a related party seller, we might have to limit how much cash can go to the managing member. And we may have to look at alternative structures in that waterfall to try to get cash to the managing member without it coming through as a distribution in that kind of 90% threshold. So that's where sometimes we'll look at a seller loan and having repayment of a seller loan, getting that factored into the cash flow, or a very large deferred developer fee can also be used to sort of, we say, soak up that cash flow. Ground rent payments is another tool that we can use, but those cash flow waterfalls in the partnership agreement, if there's something really, really important to pay attention to in that, it's, definitions, it's cash flow waterfall, and it's adjusters. I mean, those are the three big ticket items that can really trip you up, and you really need to make sure that those things are tight and that you understand how each step of that plays out.
Okay, Greg, as we wrap up here, do you want to give us a quick minute on year 15 as we get to the end of our tax credit project, at least for the investor?
Yeah, so I alluded to this a little earlier in talking about the kind of time frame for developments, but you've got a 10-year period where the property is generating tax credits. Then you've got a 15-year compliance period. Now, why do we make a difference between the 15-year compliance period and the 15-year extended use period? Well, that's because for the first 15 years, that's the period of time during which if there's any non-compliance, those tax credits can get recaptured. So the investor, even though the investor is coming into your deal at the outset and is only getting credits, they're only getting tax credits for 10 years. There's 10 years that the property is going to generate tax credits. That investor is going to stay in the deal for 15 years. And that's because they need to monitor the project for the next 5 years through the end of that compliance period to make sure that there's no recapture of previous years of tax credits. Now, there are situations where you can work out a deal with the investor so that they might exit a little bit early, maybe around year 13. And that's something that you can look at on a case-by-case basis. But typically, the investor is going to stay in the deal until year 15. So come year 15, you now need to exit that investor. And how you exit that investor is very consequential. If you're a nonprofit, then on the front end, you should be negotiating for a right of first refusal, which is permitted under Section 42 of the tax code. Excuse me, that allows you to buy the property or have the option to buy the property for the existing debt on the property plus the investor's exit taxes. So one of the things about tax credits, right, is that we're using tax structures in order to create capital. And the tax code has an elegant way of balancing things out. So when you push all of these tax losses and all these tax credits to the investor for 15 years, there's a recapture. There's a process under the tax code where some of that value could get recaptured. And that can result in fairly significant exit taxes that the investor has to pay, and those get pushed on to the managing member, even in that right of first refusal context. But if you're not a nonprofit, if you're a for-profit developer, or in this market, sometimes we've had investors that simply aren't willing to grant the nonprofit purchase option, or that somehow can't be exercised, or the exercise of it is challenged. Then the fallback is a fair market value purchase option. So that's buying out the investor. You have this investor that invested in the deal. You might think of them as just, well, once they've gotten their tax credits and their losses, then they just go gently into the night, but that's not the case. So you have to plan for exiting that investor and buying out their interest in year 15. You need to be planning for that around year 10 or 11, because the way that you buy out the investor's interest has a lot to do with their capital account within the partnership. And if they have a capital account that presents some challenges there, typically the only way you can deal with that is over several years of tax allocation. So you need a couple years of saying, hey, wait a second, we have a problem with where our capital accounts are. So for the next 2, 3, 4 years, we need to do some special allocations. We need to make some adjustments in the way that we're doing our tax returns, excuse me, in order to mitigate that problem. If you're calling up Melissa at the end of year 14 and a half, and saying, well, we've got to buy out the investor and you've got a capital account problem, there's very little that can be done at that point. The die is already cast. So that's why you need to be planning for that investor exit. You need to at least have a preliminary conversation with your accounting team, with your tax advisors around year 10 or 11, so you can just get a handle on what you're looking at. Look down the road, see what you've got coming. It may be that everything looks okay and it's all kind of going as projected, and you know what, we'll talk to you again in 2 or 3 years, but you need to do that check-in. So just be looking at that. That's why I say these deals, even though, we at the outset, we think, okay, we're closed, we built the building, we're great, now we can just move on. But 10 years is not that long. and 10 or 11 years, you need to have that conversation, and you're looking at year 15, and then you're looking at, the rehab or the recycle after that. So these things are an ongoing, organic process.
All right, thank you, Greg. I think we're at our time limit here. If anybody has any more questions, feel free to throw them into the chat. I don't see any others at this point. So at this point, I guess we'll wrap up. Danielle, thank you again for putting this together and having us as part of this. If anyone has questions, I think you have our contact information. You can reach out to us. Danielle, do you have any other things to wrap up here?
No, just that like 10 years goes quick, 50 minutes goes even quicker. So appreciate you all for being here. Yeah, if anyone wants to reach out to any of our presenters offline beyond today, send us an email at the partnership. We'll make sure to put you in touch, but super appreciate this conversation. Thank you all so much for joining. And we've
I'll
got
just
3
add
more.
to that, and I sorry, I'll just add to that, and I know the Whittlesey folks have the same attitude on this. This is why it's great working with them and being on a panel with them. But this goes for me and them as well, is that like we're happy to be helpful. You know, reach out to us. You know, I take calls all the time from folks that are, you know, it's like, hey, I've got this weird thing, or I've got this situation or this problem, you know, can you point me in the right direction? And I take those calls every day. I mean, the affordable housing world is a very small community. We all know each other. We all run into each other all of the time. You know, we're constantly bumping into each other in Connecticut. So we all try to pay it forward. So reach out to us anytime we can be helpful.
Absolutely.
Appreciate
I
it.
Thank you.
100% agree. Thank you, Greg. All right. Have a good day,
All right,
everyone.
everyone.
Take care.
Be well.
Take
Have a great
care.
one.
Bye.